This episode is brought to you by Sablier, the leading on-chain solution for token distribution. You'll hear more about them later on in today's episode. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. Hey guys, welcome back to another episode of Lightspeed. Today, I am once again joined by Dan Smith. He made it back for a back-to-back appearance, as well as our good friend Carlos from the research team. How are we doing today, guys?
Doing well. Back-to-back, and we'll go back-to-back-to-back after this, baby. We're so back.
Fantastic. Thanks for having us.
Amazing. I love when Dan locks in another future episode. It makes things so easy for me.
Gotta hold myself accountable to the people and you.
That's good. And then I can hold him accountable or threaten him on Twitter. I guess Dan and I talked last week quite a bit about prop AMMs. He said maybe he would have some extra data for me this week. That turned out to be false.
Speaking of being held accountable, we're close. We're at the finish line, but I don't want to show something I know isn't right.
Holding him accountable. So maybe the back-to-back-to-back episode, we'll have some more of that data and we'll talk about prop AMMs even more. But we still wanted to talk about them again today. I saw Dan just mentioned to me, Course 1 dropped a piece, deep dive into prop AMMs, some details there, some data there. And Carlos, I know, had some ideas here around kind of the changing landscape and market structure of AMMs and DEXs on Solana. So I guess I kind of wanted to dig into that. Maybe Carlos, if you can kick it off, like what do you see is sort of like the shifting tide here for DEXs kind of broadly on Solana?
Yeah, sure. So like just something we reiterated in the past, which is like DEX dominance will increasingly bifurcate based on asset maturity, right? So on the one hand, the short tail of assets will be dominated by prop AMMs. And on the other hand, like the long tail of assets will be dominated by traditional AMM liquidity. Starting from that, I think like the winning strategies for both types of DEXs will differ dramatically like going forward. Like if you think about prop AMM order flow, the majority of the order flow for prop AMMs comes from aggregators, and that means they must compete on execution, and that necessitates a different strategy from what traditional AMMs need. So I argue that prop AMMs will greatly benefit from horizontal integration. And you can like think about it from Humidify's perspective if you need an example. So Humidify is developed by the Temporal team, or is like the core team behind it. And Temporal also has other products, namely Nozomi, which is a transaction landing service, and Harmonic, which is a block building system that is aiming to compete with Jito. And for Humidify specifically, they benefit greatly from Nozomi, which is the transaction landing service, because they need to update their oracles many times a second. And the transaction ordering really matters to avoid them being picked off by toxic takers. I think Dan can give a little bit more data to that. So for prop AMMs, in summary, they benefit from horizontal integration, like at the infrastructure level. And then for traditional AMMs, I think what we will see is that vertical integration is a necessary strategy to avoid being obsolete. And we already seeing the starting innings of this trend. For instance, we saw Pump dominate the launchpad sector, and then they launch like their own AMM. And when they redirected graduated coins towards their own AMM, we saw that Radium lost its largest source of volume, and it hasn't recovered ever since. And so I think like the winning traditional AMMs will not be viewed as AMMs at all, but will rather be viewed as token issuance platforms. That can take like two main models, which is like the high velocity meme coin launchpad that I just mentioned, or it can be the ICO platform model, which I don't know, MetaDAO can be a great example here, where you don't think as MetaDAO as a decentralized exchange, but the tokens that are launched through MetaDAO are monetized through the future key AMM. So what you have is basically a token issuance layer, and then like vertically integrated AMM that monetizes those launches. And the important thing here is that traditional AMMs that do not have this model or do not control the token issuance layer, like risk fading into irrelevance. And I can think like of Radium and Orca, like not to pick on them, but like as the main examples of the losers of this shift. I'll leave it at that and open it up for discussion if you guys have any pushback.
Yeah, no, I mean, I think generally your thesis is one, really interesting, and two, directionally correct. Even if you look at Radium, for example, I think they're aware of this and have been trying to innovate around that. So when meme coins are hot, they experimented quite heavily there. They launched Launch Lab, obviously had the soiree with the Bonk, I think it was called Let's Bonk on the Launch Lab product, and that did quite well for a time. Of course, meme coins have kind of since been less in the limelight, but yeah, I think asset issuance is a very interesting combination. And yeah, right before the show, we were like, okay, this is exactly what MetaDAO is doing. And it's even when you try to not talk about MetaDAO, they always come back into the conversation. So that's probably a testament to the product that they're building over there. And the other interesting thing is the Futarchy AMM right now is like very vanilla, let's say, like it's as far as the AMM mechanics, and that honestly might be exactly the right thing to be doing. But point being there is the design space is still quite open. So I think they do have the opportunity to experiment a little bit on that side of things, but sort of the simplicity is a bit of the beauty right now as well. On the Oracle side of the Prop AMM side of things, yeah, the Chorus One piece was great. I think Rafa wrote that, so huge shout out to him. Really cool piece to read through, and definitely agree with a lot of the findings that they found is roughly the same that we're seeing on our side. So I'll go ahead and share screen here a minute. Sweet. Sorry. All right, you can flip it on now. So this was one really interesting chart from that. So if you look, this basically what this is, the y-axis here is the spread in basis points. So this would be a half BIP up to 60 bips of spread, meaning the gap in between the sale and the buy price, or the bid and the ask. And say the x-axis here is the size of the purchase. I believe this is in US dollars. So on the far left, we've got $1,000 buy. On the far right, we've got $1 million buy. So what this does is shows you the effective spread across these different size buckets. Now, one thing to flag here with the methodology is it basically looks for you need a purchase and a sale to occur within the same block. And that's definitely not perfect for two reasons. Really, one, this undersamples. So not every block is going to have a trade in both directions. And then two, it also assumes that the bid and the asks don't change throughout the block, right? So if you have like a purchase at the top of the block and a sale at the bottom of the block, you're assuming that there was no movement of the bid and the ask between those two transactions, which is generally not going to be the case. So for the Sol USD pair specifically, Humidify updates its quotes roughly 3 times per second. So there will likely be multiple Oracle updates per block. So this methodology is not perfect, but we do it as well. It's basically the only way to do it with on-chain data. And it probably gets you directionally right. Again, just it's important to kind of put that lens on it. There is like one level of inaccuracy or missed over this. But generally, I think this would yield directionally similar results if you were looking at this through the lens of taking away that one layer of inaccuracy. But overall, it shows that Humidify is that they quotes the lowest. And I think the volume story kind of tells you they quote the lowest spread, and the consistency at which they're doing it is another thing to pay attention to as well. And if we look at the Oracle update summary, so here you can see these are they have 5 Sol USD pairs, and 4 of them are USDC, 1 of them is USDT, and 4 of the 5 they update 3 times per second. You can see the success rate. I think mostly the success rate has to do with the pricing function. So there's probably some it's definitely more complex than this, but if price has changed, if the current price is at least X basis points away from the price that I'm trying to update at, then go ahead and change it. There's probably some conditions in there, as really my point, around why these would fail. So these are still transactions that successfully got to the chain, but they did not execute for some specific reason. It's pretty interesting to see how much they pay in fees as well. So they're definitely the outlier, and this is lifetime fees as well. So this USDT pool is fairly new on a relative basis, but these 4 USDC pools, they've paid over $1 million of transaction fees in Cheeto tips to execute these Oracle updates. So I think the one interesting thing to look at is diving into what is how much money they're making is ultimately the question, right? It's very easy to do this for traditional AMMs. You just have there's a fee that gets emitted in the logs. But when you don't have the effective spread they're charging, I think there's a couple interesting things you can do. And we're experimenting with those, making sure we can get something that just makes directional sense. But looking at a couple of these methodologies, it does appear that they are making money. The question is how much. And then when you do see the volume chart the way it looks, it's like, okay, well, what is actually driving this? So we're absolutely diving into that as well. Don't have any strong inklings on why their volume is so aggressive outside of the fact that they are quoting the lowest, and therefore every arbitrage is going to, not every arbitrage, but many arbitrages are going to run through them. And it is probably opening up some new ways to experiment with some of that arbitrage as well. But overall, no, it's the thing that jumps out to me is their Oracle update rate. So this 3 times per second is not consistent with many other prop AMMs. It's much faster. And I don't know how, I guess I don't know the trade-off space of why they're updating so frequently when others are not. That's one thing I'm still trying to experiment with as well.
Shout out to Peaq for sponsoring today's episode. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders, and the first machine economy free zone is live in the Emirates. And it's all happening on Peaq, the machine economy computer. Head to peaq.xyz to find out how you can benefit from the age of automation. That's peaq.xyz. Thanks to Sablier for sponsoring today's episode. Sablier is the leading on-chain solution for token distribution, trusted by teams like Maple, Immutable, and Axie Infinity. The #1 distribution protocol on EVM is now live on Solana. Automate your airdrops and token vesting, streamed by the second, transparently and trustlessly. Secure, audited, and ready for Solana builders. Get started at sablier.com. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. Interesting. Great data. And check out that course One Piece for those maybe that haven't seen it. A lot of good data, and I think they dig into kind of the traditional model of quoting assets in TradFi markets, and then compare that to prop AMMs, which is good, useful context maybe as you think about kind of the future, how things continue to evolve. I wanted to go back a little bit to Carlos, the idea you were making, or the thesis you were making about kind of verticalization of these DEXs with a lean towards issuance. And maybe the question I'd pose is the MetaDAO has some of that value today. They can monetize that DEX because from what I understand, you cannot trade some of those assets on other venues. The token is locked into the platform DEX that they have just due to the specific token contract. Is that something that's defensible, or do you expect that at some point eventually, the tokens sort of break away and then you just have prop AMMs quoting, futarchy assets, lower spreads, and they sort of lose the monetization angle? I'm just wondering, does that have a durable moat for them as well, or does it get taken away?
No, I think I get your question. I think the answer is that for long tail assets specifically, you need consistent launch volume. So what I'd expect is that if you look at, for instance, the future key AMM volume and the revenue that MetaDAO has generated, they usually generate the most revenue or the most volume the day one after the ICO, right? So for instance, with the Umbra ICO, they generated a ton of revenue and they generated a ton of volume. But after like the ICO hype died down, like you see less and less volume. You see kind of like the same thing with meme coins, sort of like to a lesser extent, where like newer meme coins get a lot more volume, or like newer meme coin pools get a lot more volume, like old, like 60-day old or like 90-day old meme coin pools, right? So with both launchpads and ICO platforms, you need a consistent source of like token launches that are continuously redirecting that to the like vertically integrated AMM, so that you can have like a consistent source of volume. Because you're right, like after like, I don't know, 30 days, like I'm making up the number here, but like after a certain period of time, like you can have that liquidity move to other dexes, or you can like, or if the assets mature enough, eventually maybe prop AMMs can even pick up that volume, right? So like what I argue is essentially that traditional AMM don't have a defensible moat, like as you mentioned, and liquidity is largely commoditized. So you have to win on distribution, and you have to win by like owning the token issuance layer and giving that uh, like giving a constant stream of tokens like to your AMM, basically, so that you can monetize those launches. For instance, like with MetaDAO, like it's not just the future key MM. They also have a like an LP position in Meteora, and they are also generating a ton of revenue from that. But it's very important, like in my opinion, that if you cannot compete on execution against prop AMMs, at least compete on distribution, so that you can have like a constant stream of tokens and volume like that you can monetize.
Yeah, I think this. Go ahead, Dan.
I was just gonna say, how do you feel about something like Uniswap, right? So like traditional AMM, but they built this like more platform style play with UniV4. And then they're not also competing directly against prop AMMs, as they don't yet exist on most chains where Uniswap exists. I was curious if your viewpoint changes at all there, or if this is kind of specific to the evolution of Solana market structure.
Yeah, great question. I actually thought about this. I think this is specific to Solana. I think, like, if you think about it, like Ethereum did a really bad thing for our minds, which is like it like predisposed us to think about things from only one like sector. So for instance, in Ethereum, like everything produced one winner, right? Like Aave for lending, Uniswap for dexes, like Lida for LSTs. Like I think Solana, the problem with Solana is that it is incredibly more competitive. So it has been rare to see like a durable player win in one sector for a long period of time. Like if you think about like any sector, there have been like multiple like leaders like go through time. So that's one thing. And the other thing is that um, applications on Solana are basically vertically integrated and competing against other sectors. So you can think about, like, for instance, Jupiter is venturing into lending and competing with Camino. Camino is venturing into meta aggregators and competing with Jupiter. So the lines get a lot more blurred, right? Um, and the other thing is like, yeah, market structure in Solana is much more advanced. Like in Ethereum, you don't have like prop AMMs, uh, like winning the short tail of assets. In Ethereum, yeah, like you just have like I'm not as so please correct me if I'm wrong, but like in Ethereum, I think you just have like the basic things you've seen in the past like 3 years, like Uniswap, like Fluid, like Aerodrum, like just competing over the same pool of volume. You don't really have like more advanced stuff.
Yeah, I think
just on the RFQs, last one point there is no prop AMMs yet. I'm hearing some chatter, but I haven't found anything live yet today. I think a lot of L2s can support this, though I don't think Arbitrum really can because of the time boost, how it creates a very specific market structure. That'd be an interesting thing to dive into. I don't want to derail us too hard, but TLDR, if you have one entity that owns the right to essentially be first, that will lead to picking off every prop AMM. That you can imagine a role there's 10 prop AMMs, and the value of being able to pick off those 10 versus the value of being able to protect yourself as one would always favor the taker rather than the makers. That's my thesis, at least. If anyone disagrees, I would love to hear more. But But yeah, I think you'll probably start trying to see these. There was a really good piece by I can see his PFB, but I cannot think of their name. They did an internship at Flashbots, and I believe they're a Waterloo grad. Terrible. We'll link it in the show notes. But it had a really good point around like storage slots would be very important for prop AMMs, and they're expensive in EVM land. So it actually like the Oracle update process would be fairly expensive on a relative basis. So it actually it was like a design challenge that seemed unsolved at the moment of writing. So I don't know if anyone worked around that in an interesting way though. But yeah, RFQs I think are sort of like in that same vein. And a couple of the aggregators do RFQs, like Uniswap does one, and so does 1inch. I think KyberSwap as well, but not positive.
Yeah, I don't think this is pushback. I think I'm actually agreeing with Carlos, but maybe pushing back on disagreeing that it doesn't apply for Ethereum. I think it does apply. It's just not as evident because the market structure hasn't advanced, because the chain hasn't allowed it to, because of kind of its bottlenecked by its performance. But I think you see with Uniswap, like there's never been, and maybe briefly during 2021, there have been, but like, even when meme coins have been popular, like they just launch a pool on Uniswap because it is the liquidity venue. And there's never really been much competition there. I mean, you had Sushi try to vampire attack Uni with token incentives and different things like that. But it's been difficult to like, have a tech race sort of along the lines of a prop AMM style one, because there's only so many improvements you can make when you're limited to 12-second blocks and the other sort of limitations of the EVM relative to the SVM. So I think if we continue to see like improvements on the Ethereum side, like maybe they do faster blocks, maybe they do more gas, XYZ, this, that, and the other thing, I think you probably will see more of these things that have become prominent on Solana become more prominent on Ethereum. It can't happen as quickly today because it doesn't make sense to in the current regime. But I would probably agree with you that like the setup today makes sense. Like, and you even see Uniswap, they have their, CCA. They just did a token launch recently via that. Like, I think they understand that is a sort of like a potential moat, like alongside, you want to be the DEX, but then you want to verticalize and do the issuance and the token launches as well. And they clearly see that. So I think it probably stands to reason that it applies for both. It might take longer for Ethereum to mature to the same level that the Solana ecosystem is at, just because of there's been more focus on speed and high throughput.
Yeah, that CCA launch looked really cool as well. I think they ended up raising somewhere in the neighborhood of 60 million for Aztec, which is a solid launch.
Cool. I guess maybe adjacent to this topic, since we're talking about issuance, something I wanted to dig into more was, at Breakpoint, there was some talk about different offerings in relation to, and actually, I don't know if Coliseum announced this at Breakpoint, but maybe right after. But I guess Coliseum announced this stamp offering in association with MetaDAO. And I also saw that Legion made an announcement of doing like regulated equity sales on their platform coming in Q1. I don't know what that means. Maybe it's something similar to like a stamp as well. But maybe Carlos, I guess I'll let you dig into it. But I think the question I want to ask here is, are tokens in their current form something like a stopgap until you can actually just offer tokenized equity? Because it feels like even something like a stamp, which seems to be like just a slightly improved model of, okay, let's stop doing equity plus token and like let's just do token. And if you raise money privately, then that money that investment gets converted into tokens when the ICO happens, so that you remove that kind of like dual structuring problem. It seems like all of that goes away if you can just from the get-go sell equity as a token from day one. But I think you can't necessarily do that today because legally it's not. That's a challenge.
Yeah. No, I'll answer your question first, which is, I think like investors shouldn't really care if they're trading a token or a tokenized equity. as long as they know that that has like a claim on residual cash flows, a claim on the assets, and that has legal recourse, right? Like if what I'm buying has those three, then I really don't care if it's like a tokenized equity or a token. Like I just want to buy the project that I'm bullish on, right? Without worrying about being wrong or like the team running away with the money or whatever. So that's the first question. Like the answer is I don't know how it will evolve. I just know like that's what investors want. And if that ends up being like we just have tokenized equity, then so be it. But I think like the token model that MetaDAO is launching is like a great solution like today that does not rely on the goodwill of like regulators. So it can actually act like as part of a post legal system where you have like market protected tokens and have like mechanistic a mechanistic design that actually protects token holders from being robbed. So that's what I like about MetaDAO a lot. Regarding the stamp model, if you think about like venture capital in crypto over the past few years, it has given rise to the dual token equity structure, which, as we've seen like in the past few days with the Avid DAO and Labs drama, or like with multiple other instances, like incentives are broken and it's essentially unworkable, right? Like especially for token holders who usually end up losing against like the equity investors. So the preeminent model today for raising in crypto is just like the safe model, so simple agreement for future equity plus a token warrant, and that's what gives rise to essentially these like dual token equity structure that ends up causing all these issues. So Colosseum is proposing a simple token agreement, market protected. Uh, I think I'm missing an acronym there, but like something like that, right? Like the TLDR is that instead of like having like this dual token in equity structure, you essentially allow teams to raise privately, and then leading up to the ICO, they can do that through MetaDAO, and all like the IP of the project, all the legal aspects of the project get transferred to this entity that is governed via future key by MetaDAO. And then so all value accrues to the token and the equity is worth like zero. I think Danny, you can speak a little bit more to that if that explanation wasn't very clear.
Yeah, I think that covers it. It seems to be their effort to basically get everyone on the same page. So if you have raised private investment and maybe you've even done a safe plus token warrant sort of raise offering, the stamp serves as like a notice of, okay, we are converting you at this point from the prior safe and warrant to, X portion of tokens in what is now just a token only operation, if you want to call it that. So trying to level set everyone and say, okay, there's no multi-structure thing happening here. It's all tokens from this point on, and will operate via MetaDAO. The token will go live, and the excess funds will go to the treasury and operate as per usual for the platform.
Yeah. So one of the issues with MetaDAO today, with the current design, is that essentially when you conduct an ICO, you're basically doing like a seed investment on a team, and that's the first time the team has raised. But that brings some challenges to the team. For instance, do you really want to have a token live the first moment like you're racing and you don't even have a live product yet? Like it can be really challenging to build through the noise of having a live token. And some people like it, right? Like Ram from Avicii like really likes having a live token, like that gives him constant feedback on whether or not his product is working or not. But some people don't want to have like a live token from day one, even before the product is live. So what Stamp allows is basically for people to raise privately from venture as they usually would. And then when they are ready, they can conduct like the ICO through MetaDAO, and all the structure gets converged into just the one simple token that accrues all value from the project. And it also has like some mechanistic things that you cannot like go around that give some token holder guarantees. For instance, if you think about token allocations, like only 20% of the total supply can be allocated to the investors. Only up to 40% can be allocated to the team, and the team allocation is based on like certain milestones. So the team won't receive the entire allocation unless they basically perform based to the standards, right? And that sort of sort of mechanisms is what keeps MetaDAO or what allows MetaDAO to enforce token holder rights.
Yeah, I like that they have created a function that gives founders the ability to hold back the token, while in a way that is not valued decretive to a future token. Because it's an interesting question. Like, should you have a token early, right? If you think about a startup and you're like, oh, well, we'd love to hire employees and we can incentivize them with upside in the business. Most people are not, I don't know, let's say emotionally compatible with the idea of experiencing heavy volatility. I think people in crypto are very desensitized to that because many people have been here for more than one cycle, and many people have, at least at one point in time, had 90% of their net worth or greater in crypto. And if you've been here for that long with that level of allocation, you have almost certainly rode that entire thing down from a life-changing number back down to reality. And that is an experience that is very hard to replicate outside of crypto, especially with the fact that many of those people have made that money back. So that is like this crazy emotional swing that I think a lot of at least OG industry participants have been desensitized to. And so the idea of like, oh yeah, of course, just like launch the token and, to your point, like get rapid feedback from the market with new ideas and whatnot. That's great for crypto people, but I hesitate to say that's good for the average person. I have a lot of non-crypto friends that would kill. Like, people are like, no, like, what do you mean? Like, I own my index funds and that's it. Unfortunately, I do think that's like a very cooked mentality going forward. But broadly, I think that's just how most people think. So, you also got to factor in, if you're willing to work at a startup, you do have like already a higher risk threshold than most. But still, like, I don't know. It's a really, really interesting discussion. I think there's no right answer, and it just comes down to personalities. But I don't know if you guys have thoughts on like, should you have the token on day one or not?
Yeah, I think this new design makes more sense. I mean, I think the reality is like it enables, an earlier investing round, like a pre-seed, something like akin to a pre-seed or a seed, and the token doesn't really need to be live at like the 500K like ideation valuation of this thing. Like, maybe they raise that money and then like pivots 3 times and then, finally think they have a good idea and then do the next round at that point or something. I don't know. I go back and forth on this. Like, I'm not opposed to opening up access to these types of things. If that provides something to a new type of founder who maybe is unable to raise from traditional sources, that could be a good thing. The downside of that might be that you get a lot more failures. Like, it might be that it now is like 999 out of 1,000 are dead in the water. But I think if participants are willing to play that game of shooting kind of like fish in a barrel, or like trying to get the needle in the haystack outcome, which is sort of what you're doing in VC. You make a lot of spray and pray investments and then hope that the 1 in 100 pays for the whole fund.
Yeah, but think from the employee side. As an employee, you don't get to take all of those bets. You get to take one bet. And that's where I think it's really interesting, because it is a compensation tool. So I don't know. That's the one thing.
What's like the issue on the employee side though? Just like worrying that it's going up and down?
Yeah, I don't think people can experience volatility. Think about like a regular startup that doesn't have a token, just has equity. The number's sort of imaginary. Like, you never really know what it is. And then like, every 6 to 18 months, there's just like a new number that appears, and then either you get liquidity or it goes to zero. So it's always like this kind of like fictional thing. Whereas with a token, it's very much not. All right, you can sell, and you also look at the price on a daily basis. And think about like a large company, I don't know, like Apple or whatever, or like Coinbase, right? They still give pretty good equity deals from my understanding. And Yeah, Coinbase is actually very volatile, but not in the sense of like a newly launched token on a startup that's pre-product. Like that, there's crazy level of volatility. You can get a 10x followed by a loss of 85%. And I think that is like a very real emotional challenge to give to people. And again, I think we and a lot of the industry is extremely desensitized to that because we have the mental illness of like dealing with these tokens on a daily basis. But I do not think that is normal. And that's just the caution. That's the flag I wave.
I think I agree, but I'll disagree for one reason is that I think just because the asset doesn't trade on a public market doesn't mean that those price swings aren't happening. Like you can say, oh, like I don't have an active price quote for my Circle equity before it IPO'd, but like objectively it did go plus 30x and then minus 80% and then plus 10x and then minus 80%. They just weren't, if they weren't looking at the private chart, which maybe didn't really move at all because there's not much happening. But objectively it traded like up and then down, and some people probably sold or bought some at a big discount and then sold or bought some at the next raise. Like that still happens. It's just not as visible.
That's true.
So I don't think that really changes anything about that. But I think to your point, there is probably some kind of reconciliation that needs to happen in terms of if what we're doing is technically issuing the token at like the pre-seed stage, then you probably do need to do more on the like maybe lockup side or like team and investor alignment side of like, okay, actually, if we're going live here and you've invested, then you may need to be locked up for 5 years or 6 years. And maybe we don't even start vesting until, a preset, like until you do the next raise at this valuation or like do what we think is equivalent to like actually going public at like the kind of like more IPO value. And maybe it's nothing is really, but I don't know. It's difficult because the thing is going to trade on the liquid market the whole time. So it introduces more problems there, but I don't know, that might give upside to other people who, if you have early investors who say, screw it, I'm done with this founder, I'm dumping this whole thing and sending it back to the pre-seed value, then that gives some random guy an opportunity to get in and say, I love this founder.
Yeah, okay. I think you're completely right. Like this isn't a new thing to tokens. You're just like shoving the timeline earlier, right? Yeah. Because you just tend to have liquidity earlier. Yeah, I also agree with your point around lockup structure should probably change based on where the product is in its life cycle. Maybe this is related to like KPI vesting and whatnot. But yeah, 1 year cliff when you're pre-product versus a 1 year cliff when you're like at PMF. Those are obviously different things. And it's pretty insane to think about that. The standard is like, yeah, you're pre-product, but cool. We'll give you a standard 1 year cliff for your vest and have at it. And I also think on the emotional side of things, if you cash out $10 million before PMF, just like you got to be a special type of person to still really, really care, I think. That's like also a weird challenge that you've created. The incentives are not great, to be honest.
That's probably been the biggest crypto problem, is that you get a lot of these speculative things valued up to really high valuations. And so then the incentive becomes get the token out as fast as possible before it goes minus 90%, because you'll start unlocking immediately, or, you'll start vesting and maybe you'll get a big, you'll get your first big unlock 12 months out from there. And if it's only down 50% from 5 billion, that's still a lot of money. Versus, the more trad, scenario of, it doesn't really make sense to even attempt to IPO until you've really got solid kind of business behind you and you see, either you're coming to some kind of inflection point of like, there's an opportunity for a ton of growth here, or like you can flip from growth to monetization or something else along those lines. You've reached mass market adoption. I don't know, these private companies, they're waiting longer and longer, and they're waiting for like really like that peak sentiment, peak like saturation, like peak market opportunity moment to actually go into public markets.
Yeah. I guess I look at it from a question of focus from the builder, in the sense that if you have a live token like from the seed stage, it's not that you cannot like handle the volatility as a builder. Like if you're already like being an entrepreneur, like you probably have like a high risk tolerance. it's more of the fact that you probably have people yelling at you because the token is going up and down constantly, right? And so you lose focus away from like the core product. So like Danny, with the example you gave from the Circle stock, I'm sure investors were not like yelling at like Jeremy from Circle every time that this like the like the equity was going down, right? Like whereas with crypto, it's like you get these communities and like for whether it's good or bad, I don't know, but like people will surely like be on the Discord, like yelling at the founder, or be on the Telegram chat, yelling at the founder, why is the price going down or why is it going up? And so you kind of create like this dynamic where yes, the founder should be held accountable to some extent, but also like you're losing focus away from the core product. And that's like my primary question. The other thing that I really like is like the optionality that Stamp from Colosseum brings, because you can have like the now two paths, right? Like if you're a founder, you can choose like your own sauce. If you want, you can go raise from MetaDAO at day one, and then you can have a live token from day one. You can raise permissionlessly across the internet, or you can like go the traditional route, don't have a token live, and then eventually when you're ready you can like launch your token and that accrues soul value from the project. So I really like the optionality that Stamp brings to both like founders and traditional investors. Yeah, I had another thought but I lost it, so yeah, those are kind of my thoughts on it.
Yeah, I agree with you. I think that the optionality makes sense here. I also think, I posed the question at the beginning, are tokens like a stopgap until legalized tokenized equity? I think the answer here from like a MetaDAO POV is, or similar sort of efforts is, if you can make the token look as and feel as much like equity as possible in the meantime, then either result is fine, right? Because I guess if your token basically acts and looks and feels like an equity, then it doesn't really matter whether or not you get a legalized on-chain equity offering, because you can basically do effectively the same thing. Now, there might still be some areas
Morpho is a good example of that too, right? Like the nonprofit, there's a nonprofit entity that owns the development companies across the US and Europe. Those are both wholly owned subsidiaries of this nonprofit, and the nonprofit, of course, has no outside equity owners. So it's like, I don't think that's like one for one of these examples, but like I know there's no equity entity that's going to steal cash flows away from the token. So like, boom, I'm good to go. So I do think there's like a lot of variations of what this could look like in practice. Which even when we were building out the token transparency framework, like we debated pretty heavily, like, do we mandate that you do this like one thing? Like, do you need to be governed by a futarchy? Like, do you need to launch on MetaDAO? Do you need to have this Morpho-like setup? It didn't make sense at the time because there was certainly not a clear answer then. I still don't think there's a clear answer today. And I think it's actually becoming more clear that there's multiple different ways that are acceptable. So I do think you'll see a couple different formats that suffice.
Yeah, and maybe the thought process there, and maybe I'll have to ping up Robert about this, is, let's understand and list out all the qualities of being an equity owner. And then if your token meets all of those boxes, or maybe, there's various boxes to sort of check there on the token side, that kind of ticks the checks for, how strong of a token it is from that perspective. And, maybe there's probably still some areas where we're lacking there, even on the MetaDAO or even on the Morpho side. I'm not a legal expert on securities law or anything along those lines, but clearly there are more and more efforts to go in that direction. And I think Morpho is a great example of that as well. And maybe to get back to Carlos, your point as well about like the community yelling at you as a founder in crypto. I think this as well is probably also just still the immaturity of the crypto market. Like there's plenty of retail investors in the equity markets, but I don't think like pick your favorite CEO is like getting worried that they're like mad on FinTwit because they're talking about, oh, this guy's such an idiot, he's like ruining the company. Like I don't think they pay attention to it. But I think in crypto, it's like you have these founders, they come and they raise their funding from maybe like 100 or 1,000 people that are aggregated on CT or forums or something. And so it's just, I think just due to how the structuring of the market is today. But I don't know, as it grows and as you see more, broader like institutional adoption and larger players come into the space, then I think that kind of just like it eventually as well starts to look more like the traditional equity markets. Shout out to Peaq for sponsoring today's episode. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders, and the first machine economy free zone is live in the Emirates. And it's all happening on Peaq, the machine economy computer. Head to peaq.xyz to find out how you can benefit from the age of automation. That's peaq.xyz. Thanks to Sablier for sponsoring today's episode. Sablier is the leading on-chain solution for token distribution, trusted by teams like Maple, Immutable, and Axie Infinity. The #1 distribution protocol on EVM is now live on Solana. Automate your airdrops and token vesting, streamed by the second, transparently and trustlessly. Secure, audited, and ready for Solana builders. Get started at sablier.com. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. Cool. We can maybe close that topic. Speaking of the equity markets, there is one last thing I wanted to talk about. And I know, Carlos, I think you'll have some thoughts here as well. But I wanted to talk about on-chain equities in a different format, the trading of them. So I guess there's two things that have been really hot, or maybe only one has been really hot as like a narrative. But we had like tokenized stocks come on-chain pretty early this year, like maybe in the beginning of this year, actually, to some excitement at that time, but really not much has happened there. X stocks and Backed are probably the biggest example of this. And I think a lot of the activity on X stocks you see on centralized exchanges like Kraken, who I think recently just acquired X stocks. So they're leaning in pretty heavily there. But trading volumes, I want to say, are in the like low to mid 8 figures daily across all pairs, and that's pretty concentrated at like Tesla, X, and SpyX, and maybe Nvidia. You know, some of the big names and the index. And then when you look on the equity perp side, which has been a much more recent hot narrative, people are saying equity perps are like the defining thing, like the most important trend of this year, next year. Yet, you know, I think Hyperliquid is the leader here today, and their top pair, which I think is sort of in place of the Qs, does like maybe 100 million plus in daily volume. And then all other pairs are probably similar to the spot stock offerings in the like low millions to maybe a few pairs doing 10 million plus volume a day. And pretty similar across both of them, right? It's the Mag 7, it's the indices, you know, it's your Tesla, it's your Nvidia, et cetera. And even, you know, throw in a Circle and a Coinbase and a Hood because they're crypto adjacent. And I think it probably just speaks to the people that trade in this industry. We haven't really seen like, there's no melding of the two. So like the equity perps kind of exist on Hyperliquid and they're doing pretty well, you could say. And the X stocks, you know, there's offerings on all the centralized exchanges. They're live on the Solana blockchain. Is the answer here like somebody needs to meld the two and then you'll have a really like compelling product offering of like you can trade spot and perp equities plus crypto plus all this other stuff directly on one platform? Or like how do we really see this like on-chain trading of equities taking off from here? Because to me it seems like we're sort of these markets are kind of like split out. Not seeing like, you know, there's been some growth, but it's not a ton of traction and you know, the volume is kind of lacking. So where are we going with these?
Yeah, I think you laid it up quite well there. Like, I think Solana into 2026 is going to try to be competitive with Hyperliquid on the perp side. I think there are a ton of projects that are trying to capture this market. I can think of like newer things like Bulk, which has been like cooking for a while, or like I'm really excited. I think Dan is as well for like Phoenix Perpetuals, like that will implement like a prop AMM sort of like design to the perp space. And I do think like the one advantage that Solana probably has over Hyperliquid when it comes to tokenized equities is that they have the composability of having like both the spot and the perps product. So you can like conduct like complex strategies like delta neutral things, or like you can hedge via spot and then go long via perps or whatever. And so I think that composability is actually super useful and can enable Solana to capture a big portion of that market. And when you think about like the composability of like DeFi generally, that has already translated to Solana taking some market share from centralized exchanges in other areas. For instance, if you think about like prop AMMs, which we have been discussing a lot quite lately, like Dan did a really great analysis of this, but like basically the SEX DEX arbitrage is now moving on chain. And a big part of that, in my opinion, is the composability of prop AMMs. So if you think about like prop AMMs composability, um, it enables the SEX DEX arbitrage to be moved away from like, let's say, Binance to Humidify. And because Humidify is composable with the rest of like the Solana ecosystem, you can do that arbitrage in a single atomic transaction with less risk to the trader. You can imagine like similar strategies can be conducted if you have both the perps and the spot products under one interface, so that you can like have tighter like strategies, and like bots can do more things with that.
Yeah, makes sense, Carlos. I can throw this on screen here. So yeah, to your point, Danny, doing about 40 million in X stock volume on Solana right now. That's up from about 20 million earlier in the year in about July when these things came to be. So volume is ticking up. And then to your point about Tesla really driving some of this, I think we also have pre-stocks in here, which aren't the X stocks. They're like a different entity that launches these. So that's the that's the Anthropic here and the Anduril here as well. But yeah, Tesla does the majority of volume. So on the 30-day, they've done about 23 million. And that's roughly as much as the next three combined, which would be Circle Stock and then Anduril and SpaceX pre-stocks. So we are seeing an uptick in that volume. I'm not sure what the other is in terms of the DEX categories here that are driving this volume or excuse me, facilitating this volume. But Meteora and Radium have been beneficiaries of a lot of early liquidity into these pools. It would be very interesting if the other category is one of the prop AMMs, but I do not know that off the top of my head. But we'll unpack that other category there and see what is driving that.
Yeah, I guess my takeaway for now, and I get the feeling, though I don't know that we have any data to support this as of yet, though it would be great. Maybe that's what you unveil with some more digging, is that there's probably very little organic retail trading of these today on chain. Like I can't imagine there's a lot of interest to just buy Tesla spot token on Solana, but whatever little volume there is, like, is generating some amount of arbitrage opportunity, and that's driving the majority of the volume today, I would say, because I know that Xstocks has a dashboard and you can see all the volume across exchanges, and you see very consistent volume bars across like some of these smaller venues, all doing $400,000 to $500,000 of volume a day on like 10 names or so, and you see that across like 5 or 6 venues, and so to me, it would seem as though like a lot of that is probably just them arbing the prices consistently. So probably part of the story is just there's just not a lot of organic demand today.
Yeah, if you plot that by like hour of day, US East hours, right? It's going to just be like nothing, volume, nothing. Yeah, I think generally you're right. I think the way that changes, or that what's needed to make that change, is consumer applications that are leveraging this, right? Like, yeah. If you think about like what Solana is, it's like, I think one of the new slogans I saw was like, not a SEX, not a DEX, which is actually a really interesting framing, right? You are this platform of global liquidity where you do need applications to build on top of you that you leverage that in a new and interesting way. There was so the neobank trend has been extremely hot, really in the reference of, or the framing of stable coins, and really hitting like niche markets and bringing different stable coins to that niche market based on what that market needs. But in another variation of that, which I do think you'll see because of how crowded that space got, again, stablecoins are like the only word anybody knows about crypto now. I think you're going to see a lot of those neobanks bring in equities, if not bring them in, but make them a priority over the stablecoin access. And it'll be leveraging things like Solana, where you do just have to tap into X stocks, and whatever assets are listed, you can provide to your users. And that's going to be the driving force there, in my opinion, of like what actually enables or drives increased volumes and usage of these assets, right? Because and you just need a larger breadth of assets. I think anyone following any of the Blockworks team closely has known we might be a little bit of Rivian bulls at the moment. And if Rivian was on chain, like I would probably buy it there. I had to fund my Robinhood account again, and that isn't a miserable experience. And I haven't done that in a while, so the withdrawal limits back to crypto are quite low. It's gonna be a mega pain in the ass to get back if something changes and I want to, go. Back on chain for whatever reason. And so if that was there, I would probably buy it. Like, I think the one, like, I don't know, this is probably the crypto native in me, but it's like whenever I hold a non-native asset, I just have to ask myself over and over again, like, what is the fail state here? Right? Like the wormhole ETH bridge from ETH to Solana obviously got hacked to the tune of many hundreds of millions. And there was a fail risk there of this thing can go to zero. I don't think that exists with Xstock, but I still haven't done like my full scope of research to be comfortable with that. But I do think that the fail risk is low or non-existent, similar to like USDC, right? Like, can it be mismanaged? Yes. We saw obviously in March of last year or 2 years ago, there was the Silicon Valley bank risk there that ended up being a nothing burger, but in the moment certainly didn't feel like that. So it is important to always understand what these like true fail state risks are that would nuke the thing to zero. But I feel pretty decent that's not the case with X stocks today. And you do properly get price exposure and dividend exposure, and that's what you need.
I'm going to sound like a Robinhood shill. Disclosure, I do own the stock, Dan, but for some alpha for you, and maybe for others who are disappointed, you can request an increase to that withdrawal limit. And I think they can raise it to unlimited. I was having the same difficulty with the maximum amount, but I think if you just request an increase, they'll give you an unlimited amount. What I was going to say, and props to them for supporting Solana so well, is that it's actually quite nice and convenient to take USDC on Solana and convert it to cash in a Robinhood account, and vice versa. You can swap USDC from Sol to dollars in a Robinhood account with zero fees and zero spread. So 30,000 USDC is $30,000, and you can swap $30,000 to 30,000 USDC and put it on your Sol wallet. Quite nice, honestly. I don't know that you can do that anywhere else. But to your point about more breadth, I think I probably agree, but it's maybe also a little bit of a chicken and egg problem. If nobody's trading the assets today, then it's not going to make sense to list 100 more. And I think probably the other issue is going to be like, I'm betting, and again, no data, I'm betting the on-chain spread is probably much worse than buying a stock at a brokerage. And maybe to your point, it's like, if you're some user who doesn't have a brokerage that's offering these things, maybe that's the only venue you can buy it. Then that's great for you. Like, that's cool. You'll take whatever spread you can get, but probably the majority of people who are moving in a meaningful amount of money and maybe buying some of these stocks, probably have a traditional brokerage today and don't need to buy it on chain. So there's probably a missing link here of, like you're saying, of both of these things, of like actually getting to those users who would be beneficially impacted by the product. They either they just don't know it exists, or they don't have the funds to like buy stocks in their Phantom wallet right now or something. Like, they need to afford to eat for that week. And vice versa. Maybe the assets they want to trade do not exist yet. It just needs more time.
Yeah, I think that's 100% the challenge, is like, how do you get the average American or European just to be like, okay, like, I'll come on chain to do X, Y, and Z, as opposed to doing that in the brokerage. I think it's very hard. However, counter argument, Robinhood is not tokenizing stocks for fun. I think they've up to 2,000 now. They hit their year-end target on Arbitrum. I don't think they can really move those assets yet, but everybody remembers the chalkboard session from ECC that Vlad did, right? that they're executing that chalkboard game plan pretty well so far, and their goal is to enable fully on-chain trading. And so I do think that that's worth noting as well. It's like there's a reason they're doing that, and I don't think they'll be the only one that tries to do that. And so it's very interesting to see Robinhood go this direction while you're going to see like crypto native startups going the other direction. Where do they meet in the middle? Is there even a middle? Robinhood's obviously a giant. How does Coinbase get involved here? I think there's a lot of open questions that will be very interesting as they get resolved.
Yeah, I think the brand and distribution thing is a big piece of it as well, right? I think, what tokenizing stocks does for Robinhood and probably these other like trad venues is a regulatory arbitrage in jurisdictions where they maybe couldn't get a license to offer securities. And so now it's like, okay, you can use, Robinhood, pick some country like India, and now you can trade stocks, but they're not stocks, they're tokens. And we don't have to register with the, relevant securities exchange in this country. And you guys can start trading and, holding what are basically equivalent to stocks now, and we don't have to wait, years to get that license approved. And, we onboard a bunch more people. I guess it's maybe a question of like, do people know, of X stocks in Malaysia, or have they heard of like Coinbase or Robinhood, or if there's a relevant like broker in that region? And I would probably lean in the direction of like, there's probably like a large broker that they're familiar with, and maybe they have never heard of what Xstocks is. So maybe, there might be a bit of like a branding and distribution problem to still be worked towards for some of these platforms still.
Yeah, I think that's fair.
Cool. If there's no other thoughts, I think we can close it there. I do want to say I do generally agree with you though, Dan. Like I think from both sides, there's interest. They see the value of kind of like tokenizing these assets. One, probably like an efficiency thing, an operations thing. Probably also means that there will need to be new regulations in the future as well, because I think right now it's also like an arbitrage thing of the current, securities laws in many jurisdictions. So we'll see how that plays out, but there's definitely interest on many spots along this spectrum here. So we'll see where that's going. I guess we're next week will be before the New Year's. We're going into a holiday here over the next couple of days. Wishing everyone out there happy holidays, a Merry Christmas if you celebrate it, or the other holidays I'm maybe not as familiar with that also exist. I want to be all inclusive here.
What do we got? We got Hanukkah, Happy Kwanzaa,
Chinese New Year.
Chinese New Year. Anything else? I still love you.
Orthodox Christmas. Plenty of other things. Enjoy all of them. I don't know if Kwanzaa is also in this month or a different month. But yeah, to all of you folks out there and to you guys on the call, hopefully you'll enjoy some time off, spend some time with family for any of the holidays. And we'll see you all next week. Are you guys doing anything exciting? Spending time with family? Just hanging out?
Hosting the in-laws. Send thoughts and prayers. I'm kidding. Especially if they can hear me.
Yeah, just hanging out with family.
Nice. Yeah, log off from CT and enjoy your time with your loved ones during the great holidays. And we'll see you next week. Dan with the back-to-back-to-back. He'll be back again. Hopefully the next time with the actual prop AMM extra data that we want to see. And we'll talk even more about this big topic on Solana. So until next time, we'll see you guys then.